The UK investment trust Greencoat UK Wind listed on the London market in March 2013 and currently has a market cap of just over £3 billion. The company deployed the initial and follow-on capital raises and reinvested excess cash flows to grow the portfolio, which now contains 49 operational wind farms, equating to around 7% of UK wind assets and generating enough power for around 2.3 million homes in the country. In this episode, we were joined by Stephen Lilley, partner and head of the Schroders Greencoat team responsible for managing the company's portfolio, to discuss some of the highly topical issues associated with this sector as the UK energy market continues its evolution towards greener forms of generation. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In this episode, we were joined by Stephen Lilley, who founded the then Greencoat Capital back in 2012 and leads the investment management team behind the London-listed Greencoat UK Wind, ticker UKW. The Renewable investment manager employs over 100 professionals and has over 10 billion of assets under management and is now 75% owned by Schroders. The economic model of these infrastructure assets is reasonably simple. The turbine equipment is owned by the company, but located on leased land. Whatever electricity is generated is dispatched onto the network. A fixed percentage of revenue is paid back to the landowner for life as rent, and a small amount is paid to the manufacturer for operating the turbines. This could be a fixed fee for breakdown or spare parts, and in return for a payment if availability is low as a consequence of downtime. On the revenue side of the equation, the important factors are volume and price. In terms of the production, the standard deviation or variability of wind energy is relatively low year to year and certainly predictable over the long term. In terms of the price received for this generation, this can be split into two. The vast majority of wind farms in this portfolio receive a Renewable Obligation Certificate, or ROC. This is an inflation-linked certificate which is then sold to the utility companies at a fixed price, which is required by them to give to the regulator to meet their own requirements. Our is then sold into the market, usually on a day-ahead basis, and the price received is the prevailing wholesale electricity price. The long-term and contractual nature of the cash flows received by these infrastructure assets, and the fact that the company only owns operating assets without the added risk and complications of managing development, allows us to analyse underlying valuations to determine expected potential returns. The discount rate is a figure published by many of the infrastructure investment companies within the sector, and it is the rate at which the expected cash flows of the underlying portfolio are discounted back to the present day to derive that single published net asset value for the portfolio. Another way of interpreting this figure is that all else equal, the expected total return from the portfolio will be equal to the discount rate over the life of the portfolio's assets, assuming those expected cash flows have been calculated correctly. There are two components to the discount rate: a risk-free component, typically based on government bond yields, and a risk premium component, reflecting the risk of default. The rise in the risk-free components over the last 2 years has caused a rise in the discount rate and a subsequent fall in underlying valuations. Higher discount rate results in lower portfolio valuation. We make several adjustments to the discount rate to account for the cost burden associated with the investment company, management fees and administrative charges, for example. We assume the share price converges from a discount currently to par, and we account for the impact of cash drag or gearing at the company level through time to get to an implied shareholder return, which we can use to compare with other yielding assets in the market. In this case, given the inflation linkage of part of the revenue, we compare against long-dated, index-linked government bonds. And the return premium is currently higher than historical average. It is this relative attraction why we featured a number of the infrastructure investment companies in recent episodes of the Investor Insights series. Just to note that this interview was recorded in the week before the UK general election, and please, as always, get in touch if you'd like to receive any more information on any of the topics discussed. Stephen, good afternoon. Thank you so much for joining us. How are you doing today?
Good. Yeah, no, thank you. All good. Thank you. How about you?
Yeah, very good. Thank you. Very good. So we've got a kind of standard opening question to these, and we ask a question which tries to get a bit of an insight into you, really, or your kind of typical working week, or perhaps something that you've been working on recently. So we've been asking people to share if there's maybe an anecdote from a recent meeting that they've had, or even just an article or book. We've had some book recommendations here. Is there anything you could share there?
Yeah, I read a very eclectic range of books. I actually, about a year ago, I realised that all I was doing was listening to Radio 4, either on the way in or on the way out from work, and albeit that's good. And I even managed to work out that if you get on the train, say at 7:30, and you set the Today programme to 6 p.m. on the radio on your phone, you could continue listening to it on the underground. That's quite a clever trick because it obviously records the whole program. Yeah. And I got to the point where I realised that it was fine to listen to the news, but actually I'd got a whole stack of books that were building up, so I just needed to start reading them. And so I have a very eclectic range. But one of the books I got from one of my colleagues actually was as part of a Secret Santa, the head of our American business, David Boyce. I can't remember the title of it, but it was all about Lewis and Clark, who, if any of you remember, you probably don't know, but these were two soldiers that Thomas Jefferson, in about 1804, tasked with going basically across to try and find whether you could link up the Pacific and the Atlantic via the river system. So they sort of go up through the Missouri, up in, and they end up near Vancouver, near Seattle. And there's a book all about 4 years of getting across, getting back. No communication, really interesting. And how do you bribe the Indians not to kill you, etc. And that was really, really interesting actually. And different world, and even things like there's 5 million, only 5 million Americans in about 1800, of which 20% were slaves. Unbelievable, isn't it? I mean, just how the world is different.
Yeah, absolutely.
Anyway, that was fascinating. But so all sorts of books. So you also sort of asked, I guess, what's my sort of normal week like? I don't really have such a thing as a normal week, but so I looked at my diary for this week, which I thought was quite interesting. So on Monday, what I do on Monday, I had about an hour and a half with Matt and Lucinda, our chairman, just going through 4 or 5 things that we're sort of doing and working on at the moment in advance. But we meet her every so often, so that was good. Did some HR stuff, started drafting a chairman's statement for the half-year results. Tuesday, we sort of, on a Tuesday, we generally have an event, a management committee in the morning for all the Greencoats, so I did that most of the morning. We're going through a refinancing program, I guess, for some of our term debt, which we can talk about later on as we go through. And we had a bit of a going through what bits are and what terms do we want to take and how that would look against the stack of debt that we have already. And so we went to what do we want and how do we progress that? Great appetite, but it's a choice. It's a problem of choice, I guess. So we did a bit through that, and then yesterday interestingly, we took some investors out to London Array, which we tried to do last summer, but not to London Array, but to Burbo, and it was too windy. Yesterday, there was a bit of wind, but I've never had this on an offshore wind farm. It was foggy. And so we went to London Array, 175 turbines. We saw a turbine at a time. The fog was 500 meters, and the turbines were a kilometer apart, so we could only literally see one turbine at a time. And also, it's also interesting because there was a little bit of swell, but it wasn't particularly noticeable in normal conditions. But because the fog was in, you couldn't see the horizon. You couldn't really see anything fixed, and therefore people started feeling a bit queasy, in a way that you wouldn't expect. Even I did a bit, but you wouldn't expect that. So then we had a foggy trip with investors up to London Array. We had some stuff on with pension fund who wants to co-invest alongside us. We had a little bit of a chat with them. We're doing a little bit on refinancing. We also did some stuff on the how do we bid volumes into the balancing mechanism, which is a live topic with Ofgem and the system operator at the moment. So we were talking a bit about that from a sort of technical perspective. And then I'll talk to you today. It's the highlights of the week. So
good to hear. They're a very varied week. Yeah, I imagine that's not most weeks. But so Stephen, maybe I wonder if we could maybe just set the scene with the kind of first proper question of I wonder if you could maybe summarise the economic model of an operational wind farm, just to kind of frame things for the rest of the discussion.
Yeah. So of our business, if you like, then we'll go on to each farm. So our business is pretty straightforward in the sense that we have 49 wind farms. One of them has project finance on, the rest doesn't. We have 30 to 35% debt generally on our business. And it throws off, have a dividend that we always want to increase with RPI. We've done that 10 times, and then last year we increased by 14.2%, not 5.2%, to get up to 10p. So that's dividend increase with RPI, and then preserving NAV on a real basis. So at the end of the year we had 64% versus 54% of compounded RPI. So those are sort of things that are about, I guess, the 13, not many years after the credit crunch. Yield and RPI protection on both dividend and capital. So that sort of is a general sort of rule of business and of our model on the fund. And that sort of effectively comes from, we run about 50% exposure to merchant power price and 50% exposure to ROCs predominantly. And those certificates are RPI linked. So that's where the RPI linkage, the strong RPI linkage, comes from. On an individual wind farm, then, it is, we started off with ROC projects, so they in general had a mix of an RPI contract and then exposure to the merchant power price. Now we want to have that exposure to the merchant power price because it's a way of getting sufficient return, but doing it in a controlled fashion. And why we want exposure to that is that it's a pretty much an asymmetric risk. We don't run a lot of leverage. We have an EBITDA margin of about 75%. And therefore, we're very well capable of taking the downside risk. But because of the low leverage and the certificate, the ROC certificate, it means that power prices in the downside can go very, very low in a way that gas would never produce power, because it wouldn't even cover half the cost of carbon, and we'd still be fine. But ultimately, by taking that exposure, it gives us the exposure to the upside power prices. And obviously, we saw in the last couple of years with high power prices, we got paid very well for that. And so for us, it's a business that has an asymmetric risk on the upside for power prices, but with the stability of an infrastructure business effectively that copes very, very well, if you like, in the downside. So that's sort of how that works. Then in an individual wind farm, 75% EBITDA margin. Obviously, we don't have a lot of cost. We have exposure from a revenue perspective. We've got two key components. That we've got volume. So wind farms aren't particularly volatile in terms of production, i.e. volume. there's a standard deviation of plus or minus 10% for production every year. So that's what we would sort of kind of expect. And then there's volatility to half the revenue stream, if you like, the power price, and that has got a whole range of factors that sort of go into that. So for which we can I think probably is the next question we can sort of talk about. So I think for us, we very stable business, volatile, not volatile. Yes, it's exposed to the power price, but the stability of the certificate that's RPI linked. Not running a lot of debt, and out from that comes effectively a 10% return net to investors if you're buying it now. Obviously, about 12% where it is at the moment, where we're trading at the moment, and that we think compared to a 10-year gilt of just over 4% is a phenomenal return for the volatility we have in this business.
Yeah, no, we've certainly seen that return spread widen. We'll perhaps touch on some of the issues the investment company sector are facing at the moment later on. But I did want to touch on those power price forecasts. I mean, you kind of briefly referenced what we've gone through in the last couple of years with since the conflict in Ukraine, a few other perhaps more specific issues in France with their nuclear assets, for example, in the short term. But those long-term forecasts they are a key factor in valuing these assets. I wondered if you wouldn't mind running through the kind of primary inputs into what sets that price. And I know you use kind of third-party forecasters feed into this, but I wouldn't mind running through what their kind of key considerations are to estimate how this evolves over the long term as the power market changes.
Yeah. I mean, ultimately, obviously, it is about supply and demand. So dealing with supply, you've got in the long term, you've got all sorts of factors. For instance, like what happens with the nuclear fleet coming off, and is the nuclear generally base load. So if there's any nuclear, it's on because it's pretty much free on a sort of marginal basis. And then how much renewable is going to get built out? What about interconnections? So you talked about in French nuclear, that will come through into interconnections. So how is interconnection working? And then ultimately, what about gas? So ultimately, 90% of the time, gas sets the power price, and it sets the power price on what's called a merit orders, which is the all of the where supply and demand meet. The last megawatt hour of supply sets the price for the whole market. That's how the UK market works. So at the moment, that's gas. In terms of how does the gas price set price? What is the gas price? If you like, it's got. This is what people are bidding effectively to run their kit. So if you burn gas, you have to pay transmission. You have to pay effectively network charges. That's probably say £5 a megawatt hour. If you're burning gas, you've got to pay for carbon that you're using, so that's probably £20 a megawatt hour. And then you've obviously got to get a return on gas itself, and that has got the return on the kit, but also what's called spark spread. Your ability to better go and buy, even if you've got no return on the kit, buy that, and those are sort of the three key components, and that gets you pretty easily. Remember, half of that probably is carbon and networks, all the way up to about £50 a megawatt hour. So it's pretty straightforward in one sense. That is where supply comes from. Obviously, as you go forward, what happens with nuclear, what happens with renewable build-out, for instance, will then have an effect on what the mix is. And I think we got into some slight confusion a few years ago with Bloomberg effectively sort of saying, well, if there's this nuclear build-out, if there's this renewable build-out, gas will be setting the price, less than 50% of the time. Therefore, the average price will be, and then a ridiculously low number, which made you then realise, but problem is you're only dealing with supply, you're not dealing with demand. No one would build that out if that was the case, and the renewables wouldn't actually happen. Therefore, it's self-fulfilling, would never happen. and a lot of some of the consultants, including the one that we use, came out to the market and said, that's just bonkers. It couldn't possibly work like that because you wouldn't even cover the operating costs, and therefore it would never happen. Now, in terms of demand, you've got, and this is actually probably what's happened since then, so it explains it an awful lot better, is that as you get toward the back end of the next sort of 20 years, perhaps, what we start to see, either you'd have government policy that might come through the Renewable Electricity Market Arrangement Review, REMA, at the moment, which is, stopped because of the election, etc. But that might come through in due course. It might be that they start to not just have one power price, but they might have a clean power price, including sort of nuclear and renewables, etc. That's separate from the carbon, if you like, power price. Say gas, coal, not that's that likely going forward. And so they may back the market, which is fine because we're effectively something akin to a set price, and that's fine for us. We wouldn't mind too much if that was the case. But assuming they didn't, which is obviously what you've got to do before it actually happens, in the long term, we would expect more demand comes on the system, and that's because you have a lot of the stuff that needs to decarbonise, like transport, for instance, like heat, will become electric in due course, and therefore demand goes up. Obviously, people will probably understand. If you have a hybrid or you have an electric car, you plug it in, it doesn't turn on until probably 9 in the evening. At that point in time, it turns on. If we have a hybrid, we have a pod point, and you plug it in and think, why is it not turned on? Because it's set to come on about 9 or 10 in the evening, and so you're taking power later on when it's not being used elsewhere, or maybe it's 10 or 11. I don't really know. The matter EVs are a bit akin to a battery, if you like. So you're sort of charging up and you're discharging it during the day, and it's a way of decarbonising transport, and there were some arrangements to that. The other big thing I think that is really interesting, and I hope if Labour gets in the GB Energy, GB Electric, whatever they're going to call it, decides to concentrate on stuff that really could be helped, if you like, not just sort of pitching to buy more offshore, which private sector is probably perfectly capable of doing, like us, etc. It's where the GIB became a bit stuck, because it didn't do the stuff that it was really set up to do, hard stuff, and it then decided to compete against the private sector, which was a bit odd. But if it can go and work on hydrogen and getting hydrogen electrolysis to work properly, you've then got a whole system where that can mop up potentially huge volumes of the offshore wind build out, and ultimately at the back end, when instead of having too much supply and too little demand, it will have a lot of demand, and it will be akin to storage, but in real big scale, industrial scale, and something will actually help the country decarbonise it in big scale. So we're pretty hopeful for that. We have got a team internally that's looking at doing it at Schroders Greencoat more generally. We think probably part of the GB, let's call it energy, hopefully could be quite good in terms of doing that. I think certainly the noises from the Labour Party, and certainly from the times that I've met Charles Mills, Keir Starmer, etc., they've been pretty much wanting to go, even a couple of years ago, and getting into trying to meet their 2030 targets, and knowing that if they didn't start 2 years ago, they wouldn't meet them. So I think that we've got a pretty keen counterparty there, assuming that Labour does win the next election.
Yeah, thanks for that. We could cover quite a few topics in that. You actually ticked off quite a few of the questions I was going to ask on things like government policy, and actually worth noting that we're recording this the week before the UK general election. I know you also covered off some of the issues around kind of new technologies in this space, such as hydrogen and battery storage, and kind of how they fit into the equation. Perhaps we'll come back to some of those points if we have time shortly. But I wanted to perhaps bring you back to, you mentioned, I think, in the first question about negotiating new borrowing, but we've obviously gone through a pretty significant shift in the economic environment over the last couple of years. I wondered if I could ask you to discuss the the company's sensitivities to factors such as inflation and interest rates and borrowing costs. Could I ask you to do that?
One thing is we found really weird, even a little bit over the last year, was when inflation was higher than people expected. Our share price went down, which actually was almost slightly the reverse of what should have happened, because actually we're slightly levered exposed to inflation. And I think people sort of thought, well, inflation is higher, therefore interest rates will be higher, and therefore relative returns won't be as good. But actually, if inflation is higher, our returns are higher, almost on a one-for-one basis. So we're pretty neutral to inflation, either on the way up or on the way down. And so we're scratching our heads thinking people don't understand this, but it's okay. So inflation, I think, is something that is it must have slightly here or there, because of all the linkages of inflation in terms of costs and in terms of revenue as well. In terms of cost of debt, so we would expect our cost of debt to go up slightly. We have got, and I obviously alluded a few minutes ago to part of the task this week is talking about refinancing some of our term debt. So we've always run corporate debt until Solvency I, which we've got obviously the term debt on that, but we've always run just corporate debt, and we've done that in the banking market generally, and some institutional debt now with AXA, but we've done that on a like a utility would with in the bond market, I guess, with a certain amount this year, a certain amount next year, the year after, going out 7 or 8 years. And so some of those need refinancing, the cost can be slightly higher. Our total cost of debt at the moment is just a bit over 4%. We would anticipate that probably going up towards about 5%, probably not going any higher than that as we start to refinance, as also expected rates come down a little bit. And so we would probably imagine that some of those are shorter tenors over the next 18 months, 2 years. We would probably put out 5 or 6 years. Actually, if you look into the banking market, rather interestingly, and it doesn't normally happen this, if you looked at the swap rate out 5 years is lower. This is very unusual, and it's to do with who is buying bonds, corporate bonds, who is buying, or gilts, and who is buying debt, bank debt, etc. So the swap rate is actually about 30 basis points below the gilt rate, which is a bit odd because that's the risk-free rate, and that's just to do with who's buying what. But actually, if you look out into that sort of tenor, their debt is considerably cheaper. Actually, so we imagine we'll put some of the shorter term out 5 or 6 years and benefit from that. But we don't. We have just tried to, I suppose, over 11 years, have a product that is low volatility, not risky, not high leverage. It's not all about return, I'll come to return in a minute, but about paying a dividend that always increases with RPI, always has real NAV preservation. We do that with a modest leverage, 35%, and yes, the cost of that's gone up a little bit because we're not running a lot of it. It actually isn't that sensitive.
Stephen, I think in an earlier question you kind of very briefly referenced the current share price discount and some of the headwinds that the London listed investment company sector's facing at the moment, and it has kind of put a greater near-term scrutiny on capital allocation for the whole space. Or maybe you could talk us through the kind of company's current priorities in respect to how you're allocating capital.
It's really interesting. It's really frustrating for us because we got massive opportunities. We've got to scale where we can really make sizable investments, so especially with the sort of co-investment that we can put alongside the UK Wind and a big balance sheet for UK Wind. I mean, how we sort of think about it, I guess, is that we do believe in the capital asset pricing model. Therefore, we do price again. We have 2 different discount rates, one for merchant, one for fixed. We look at CAPM and we look at gilt rates, say, etc. When we're looking at what those discount rates should be, because we have obviously a merchant and we have a fixed cash flow, so we should have 2 different discount rates. And so our discount rate is higher than it was at IPO. We have got a return on our business now of about 10% net to investors. We think that's good. We've talked about that before. I think what we've seen since our listing is that, and I guess it's the privilege or the benefit of being just a UK wind investor, and that's what we do. But because the market is so big, we've never had to try and we've never been in bidding wars in the same way that some of the smaller sectors, say the solar sector's been in, perhaps. And we've never sort of said, well, because prices in the market are such, our discount rate's gone down, it's gone down, it's gone down. And therefore we haven't ever really taken it down too much, a little bit, but not a lot. And then obviously when rates have gone up, we have put them up. We think that there's most of the sector, if not all the sector, have taken rates down and haven't taken them up enough. So when people come and say to us, there's some of your peers, do you want to do a public takeover? We sort of scratch our head and says, yeah, but problems we don't believe NAVs, and so we can't. One, they'd be diluted, returns in wind are higher, but actually we just couldn't justify the NAV, and therefore no, we can't do it. How it affects us effectively, we think our return is sufficient for us to be a boom already, but because we're the biggest company in the sector by some distance, I guess, we have much higher liquidity than anyone else, and so therefore, if there's any redemptions, it's hard for people to go do that from much smaller companies. So we get hit effectively, and that's about liquidity and bigger stock, which is a bit frustrating because it's not much to do with value; it's about liquidity.
Yeah, some important points in there. We certainly are starting to see more kind of corporate activity or activist activity in the space. So that's a kind of sign that all of that is coming through. And yeah, Stephen, I wondered, probably time for one last question. I wondered if it's a slightly longer term one, perhaps. I recently listened in to some of your Capital Markets Day presentations, and there were some quite interesting ones on some of the environmental considerations that you've got in terms of the recycling at the end of kind of project life, or things in asset life extensions that you've done. I wonder if there was maybe one project that you could just talk us through about kind of what you're looking at, how you're evolving yourselves.
Yeah. Well, there's a whole lot there, but one thing that I think is sort of kind of interesting is in one sense it talks to the DNA of Greencoat, but we are, if you looked into our office, you'd see half the people on the floor are engineers, and we are a financial investor, but kind of not. We sit very much alongside our colleagues at SSC and RW and EDF, etc. And so when we come onto investments, they're kind of keen because they know that we'll bring some real technical knowledge of how to run assets well, and potentially sometimes better than they run them themselves. So some of that we saw a few years ago with getting better performance out of our turbines, software changes effectively. So you sort of turning turbines off at the back end of the power kit when it's windy. Can you turn them down? And so you turn blades out of wind, but you don't damage the kit, but you just get a bit of power that you wouldn't have expected. And that's just a software change that says turn to this number of degrees offset on the blades, not the zero effectively. So we sort of introduced that, and that's been a thing we've then introduced into other sites with our co-investment partners, our utility partners. And then the other thing that's probably quite interesting is another software change that you get on the power curve at the front end. So as wind increases, you get to full power effectively. Full power then, as you start to get higher full power, we can't get higher full power rather. As you get from that point, you start to turn blades out of wind and spill wind until you get to the back end. But that bit where it's sort of, there's a shoulder, if you like, from where it gradually increases to where it goes flat. There's a slight sort of turbulence effect of where the blades distort the wind direction to your meter at the back, your anemometry of what actually the wind direction is. And therefore, the turbine is very slightly turned out of wind and is not at full power as a consequence. So we've done a fair bit of work trying to make sure we can work out what that distortion is, so that we can then offset it the other way to turn it actually into full power and remove the cut of the shoulder, if you like. And I think that's been a thing that's been really valuable. And we've always been very keen to describe to the market what we're doing, because ultimately we do care about more breed production. And if one of our editors' wind farms could produce more, that's great. We'll tell them how to do it. And we want to share that, if you like, because it's better that we have more green power coming out of the system more generally. So those are two things that we've done. Those are all software changes, but they're the DNA of our firm, if you like.
Yeah, all different ways of trying to eke out more generation and more return from the assets. Yeah. Stephen, it's been super interesting chatting to you. I really appreciate your time. Thank you for joining us.
Good. Thank you for your time.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.